Have you ever heard someone say, I'm going to pay so much more in taxes with my raise and bonus? Or wondered maybe why your refund changes every year? Federal income taxes can seem confusing, but once you understand a few basic concepts, they become much easier to follow. I'm Bobby Finn with Beacon Light Wealth Management, and today we're covering how income taxes work, what a progressive tax system is, the difference between marginal and effective tax rates, standard deduction versus itemizing, tax deductions versus tax credits, and a few common tax planning opportunities that many people should be aware of. Let's jump in. The biggest tax myth we hear is that moving into a higher tax bracket means all of your income gets taxed at a higher rate. That's simply not how the U.S. tax system works. Federal income taxes are progressive, meaning different portions of your taxable income are taxed at different rates. Think of it like filling up buckets. You fill the lowest tax bucket first. Once it's full, the next dollars go into the next bucket. Only the dollars that spill into the higher bucket are taxed at the higher rate. Everything below stays taxed at the lower rates. So getting a raise generally doesn't mean you'll take home less money because you've entered another bracket. It simply means some of your additional income may be taxed at a higher rate. Key takeaway, your tax bracket doesn't apply to every dollar you earn. It only applies to the income within that bracket. This brings us to another important concept. Your marginal tax rate is the rate applied to your last dollars of taxable income. Your effective tax rate is your average tax rate after all the tax brackets are blended together. For example, someone may be in the 24% tax bracket, but only pay an effective tax rate around 15%. That's because much of their income was taxed at the lower rates first, or those first couple buckets. Those two numbers are very different. It's one of the most misunderstood parts of our tax system. Before the IRS calculates your financial or your federal income tax, they generally don't tax every dollar you earn. First comes your gross income. That's generally the income you receive before deductions. Then eligible deductions reduce that amount to arrive at your taxable income. For most taxpayers, the biggest deduction is the standard deduction. It's a fixed amount that you can generally subtract from your income before calculating taxes. Most people claim the standard deduction because it's simple and often provides the greatest benefit. Others choose to itemize deductions instead. That means adding together certain eligible expenses such as qualifying mortgage interest, charitable contributions, state and local taxes, medical expenses if they meet requirements. If those eligible deductions total more than your standard deduction available to you, itemizing makes more sense. People often use the words deduction and credit interchangeably too. They're actually very different. A tax deduction reduces the amount of income that's taxed. A tax credit generally reduces your tax bill directly. Here's a simple example. If you qualify for a $1,000 deduction, you didn't save $1,000 in taxes. Instead, you reduce the amount of income that's taxed. A $1,000 tax credit, on the other hand, generally reduces your tax liability by $1,000. Both are valuable, they simply work differently. While everyone's situation is different, there are several common ways people may reduce taxable income. Contributing to a traditional 401k reduces your taxable income in the year you contribute. Depending on your circumstances, contributions to a traditional IRA may also be deductible. If you're eligible for a health savings account or an HSA, eligible contributions may provide favorable tax treatment as well. Also remember that your filing status, such as single or married filing jointly, can affect your tax brackets, deductions, and other tax rules. Finally, don't confuse paycheck withholding with your actual tax bill. Withholding is generally an estimate that's paid throughout the year. When you file your return, the IRS compares what was withheld with your actual tax liability. That's why some people receive refunds while others owe additional taxes. The biggest takeaway is this: taxes aren't just about how much you earn. They're about understanding how the rules work and planning throughout the year. Remember, higher tax brackets don't tax all of your income. Your effective tax rate is usually lower than your top tax bracket. Most people use the standard deduction. Deductions and credits work differently, and many tax planning opportunities happen before December 31st, not during tax season. If you enjoyed this video, be sure to like, comment, subscribe for more videos on taxes, retirement planning, investing, and other financial planning topics. If you'd like to discuss how taxes fit into your overall plan, we'd be happy to have a conversation. Disclaimer, this video is intended for educational purposes only and shouldn't be considered tax, legal, or accounting advice. Be sure to consult your tax professional regarding your specific situation.